Hello, YouTube followers. This is Lisa here. Thanks for watching this video about my YouTube channel today. Yay! It's not just me, so it's another pretty face we've got here, and that is Elijah Young, who I worked with for how long? Elijah, was it 2018, 2019, maybe?
18, I think. Yeah, it's been over 4 years. Over 4 years, yeah.
Yeah, that sounds right. That could be right. So Elijah comes to us with 14 years in the banking industry and 5 years in the mortgage industry. So welcome, Elijah. Thanks for being my extra special guest here on my channel today. We are going to talk about a thing that came across my desk that I thought, since I wanted to know more about it, you probably want to know more about it watching this channel, and that is because interest rates are going up. I mean, they were so low for how long were they? In the 2-3 range.
Yeah, we were there for 4 years almost.
Yeah, I mean that's what we in this industry call free money because you know the rate of inflation. The reason you can say that is the rate of inflation is higher than the interest rate on home loans. It was, and so basically, you know, you're getting that money. Not, you know, you are paying something, but you know, it's basically it's a wash, right? So this came across my desk, the 2-for-1 buy down. And rather than me messing it up, let's just hear from Elijah. Go ahead, Elijah. Tell us what all that's about.
Awesome, Lisa. Thank you so much for having me today. 2-1 buy downs. They're very popular right now, especially where rates are at, you know, being so much higher than where they were before. A 2-1 buy down is a great opportunity in the financing world to be able to pay some money up front, whether by you as a buyer or even in tandem with the seller as well. The seller can pay for this for you as well. So, but what it does is it reduces your interest rate for a couple of years to put you in a position to better kind of transition your way into home ownership. So it's not no tricks, no ponies, nothing like that. It's just really straightforward, awesome program to help people, especially as you look at payments and how much interest rates affect those payments.
So you kind of, because I've got a lot of buyers that I've been working with, they're like, you know what, I'm on hold now. So rather than taking the hit all at once up front, right? What the 2-1 buy down does is it lowers the interest rate to something that you could kind of manage your first year, right? And then the next year, 365 days later, that rate goes up a percentage. Now, is all that set in stone at the beginning of the loan?
Yeah, great question. Yeah, so what'll happen is on your 2-1 buy down. So it's simply that it's a 2-year interest rate deduction, or 2% interest rate deduction for the first
2%?
year, and then a 1% interest rate reduction for the second year. And then as you move into the third year of your home, you're now at your fully amortized payment that we've already been calculated since the beginning. So you do have to qualify, obviously, for the fully amortized payment. But what it does for a lot of buyers, especially in this market when we're seeing an increasing rate environment, is the opportunity to be able to get into a home, still have, so say today, we'll just say, as an example, market interest rate 6.5%. We qualify you at the 6.5% as you get to the third year, because we do need to show you can repay the loan. But essentially, you have that 2% reduction for the first year. So now you're only being charged 4.5% on your interest rate, and so your payment is reduced. So your first year in the home, you have an opportunity to transition. You can save a little more. Obviously, a lot of expenses come with buying a new home, and so it lets you kind of ease into the home ownership process. But the coolest thing about a 2-1 buy down is the money that's put towards a 2-1 buy down. Whether it's from the seller, whether it's from the buyer, combination of both. If at any point during the process, the first 2 years, any money that's been put towards this 2-1 buy down in a refinance transaction is put towards the principal balance of your mortgage. So say interest rates drop, say we're at 6.5 today, and they drop down to 5.5 in 6 or 7 months, you can refi your house. And the money that was put towards your buy down isn't lost. It's actually applied to your principal balance, and you can refi at the 5.5%. And now you're at a permanent rate of 5.5 rather than wondering, you know, in 2 years, I'm going to get to the 6.5. And you can do so at any point during that period of time. So even if you're in year 2 and rates kind of fall out of the bottom and you get into the 4s, you can refinance. And again, any principal left that's within that 2-1 buy down allows you to pay the principal down and take the lower interest rate. So it's a great program. It's not money that you lose. There's no fee to do it, so which is amazing as well. So all the money that's put towards a 2-1 buy down is completely benefiting the buyer.
Well, yeah, you answered my question before I could even ask it, which was, can you refinance it if rates go even lower than, let's just, I mean, who knows? I'm not, I don't have, where'd my crystal ball go? I lost it. I don't have one. You don't know, but if it should go down, you can refinance, is what I'm hearing you say.
Yes, yes, you can. You certainly can. So again, the opportunity to, okay, knowing where we are in this market, interest rates, God forbid they can go any higher. But if they do, they get into the sevens or maybe into eights, you're in a great position, especially on the 2-1 buy down, that you've already put yourself at a lower interest rate for the first 2 years. So you can actually wait out that period and kind of see where interest rates go. Obviously, myself as a loan officer will keep track of those, you as an agent, and we'll make sure that we reach out to any client that's in that process to take a benefit of a refinance. But ultimately, if you get to year 2 and rates still are high, and they haven't made a move, then again, you're still more in a more beneficial position because you're now saving on at least 1% and being able to have that lower payment for that second year. So, our cycles change quite a bit. Like you said, that crystal ball, I'm still looking for it too. And so in terms of being able to know where rates will be, we can always expect them to go down. We can see all the indicators that they'll go down, but again, we never know exactly where they'll be. But at the end of the day, if we can put you as a buyer in the position to have a lower payment, be more comfortable in the home, really is the biggest thing about a 2-1 buy down. And a huge benefit of 2-1 buy downs as well is a lot of spouses, married couples, one person's working and the spouse is not. And maybe the spouse is planning to head back to work within that first 2 years of being in the home, whether it's schooling they're going to finish or, they have kids at home that they'd like to take care of. This is a huge opportunity to be able to lower that payment for the first 2 years while the spouse or significant other goes back to work, gets back into the workforce as well. So then it becomes more affordable. And as the payment increases, that's okay because we already have someone who's being added to, the familial income. So great opportunity there as well.
Well, that's a good idea. I hadn't really thought about that. As you have been presenting this to your potential clients, what's been the response? I mean, I don't know if this is a new program or if this has been around for a long time, or it just kind of was on the shelf and now that we need it, you've dusted it off and brought it back. I don't know any of that. So, what has been the response from people out there?
Yeah, you hit the nail on the head. It's a product that's been around. It's something, an opportunity that people have been able to take advantage of for a long time. It wasn't necessary. And obviously, with such low
buy
rates.
Down for what?
Yeah. You can't buy down to zero. So, but a 2-1 buy down has been around for quite some time. It's not something that a lot of people will use, unless they really have to. So, in this environment where we have higher interest rates, it puts us in a position where it's a great idea, we just did exactly that. We dusted it off and said, hey, you know what, this is a great financing tool to be able to lower monthly payments for people, especially as we see interest rates going up. And the cool thing is in this market, particularly as we turn into a buyer's market where we're getting concessions and we're getting additional things from the seller, due to the amount of equity they've received over the last few years, there's a huge opportunity for the seller even to pay for this buy down so that you as a buyer, you can pay your down payment, your closing costs, and maybe even get a seller concession to cover this buy down from the seller. So it doesn't have to be fully financed from you. Like we said earlier, it can be financed by both parties, put you in a position where you're able to go ahead and supplement that payment for the first 2 years.
Good. So the response has been positive from the people that you've talked to?
Yeah, a lot of people have been really open to it. Again, it can be, if you take it on as a borrower, it can be a little expensive on your own. But again, if you've got the funds to do it and you really want to go ahead and you kind of get to put that money back in your pocket as you have the lower payment for the first couple of years. So a lot of it comes down to analyzing the situation for our clients. What's the long-term goal? What do we see happening within the next year or two that could change your situation to where the payment is now more manageable? Whether it's getting a new job, getting a promotion, adding, like we said, a spouse to the income. A lot of things change in 2 years. So being able to have that time period to make the decision. Again, we've also talked about rates falling down, putting you in a position to be able to refi as well. So those that are really, everyone's been really open and willing to listen. It's really caught on, especially to those, in the higher priced homes, because 2% on a $500,000 or $600,000 house is quite substantial on your payment. It could be a few $100s. Whereas if you're buying in the $200,000-$300,000 range, it may not be so significant for the cost, but a lot of times when we're looking at an interest rate environment that we're in today, being, you want to have the lowest interest rate. So putting yourself in a position where you can save for the first 2 years, be able to do what you need to maintain the home.
Well, it sounds like a great option, especially for those who were kind of in the process, and then we hit May, June, and then, and then we saw it, obviously, when that happens, inventory goes up, which happened. But it sounds like it would be an option for some of those people that thought to themselves, well, I can't do this now. I've got one client, she's younger, she's late 20s. I used to work with her, and she said, I'm at least 2 years out now. And I said, okay, but having this program might entice her to say, okay, well, maybe it's more manageable than I thought it was. So options for people.
Definitely. And that goes for plenty of clients, like you said, people that are expecting a change in their income, and even people that may be expecting inheritance or may have a financial windfall that's coming their way, being able to get into a home now as the market still continues to see price increases. The values of homes are going up, although we see some price reductions on listings. They're appraising for the right value. So when you think about those things, I know we always say, renting is a 0% return on your investment every single time. And so as you buy a home, and you can at least know that, okay, I've got the opportunity to keep my payment low as everything continues to adjust. You own an asset and it's appreciating in value, and you're putting your money towards something that's making you some money on the back end as well. I know you and I, as agent and loan officer, we don't go and tell our clients about investments unless they really have a question about it. But at the end of the day, everyone is going to look at their home as an investment at some point, whether it's upfront or after a few years of being in it, to see what they can do about upgrading and moving on to a bigger, better house. And so when we think about those things, if we can save you money for the first couple of years as you transition from college and into your career, or and maybe you're going to change jobs completely, and enter another career, as you see your pay increase, it makes it a lot more easy for you to kind of make the payments and not have to worry so much about those changes.
Right. Well, good. Well, good advice. We all learned something new here today. I think I did, for sure. But it does sound like a really interesting product. It's been around, so it's not like you're taking a risk on something that, when, for example, when what were those called?
The ARMs and the stuff like that.
Yeah, and the reverse mortgage. When I first heard that, I was like, wait, and I still have a friend who used to sell those, and I'm like, I mean, and when you hear the theory, you're like, oh, okay, maybe, but I still don't understand enough where I'm like, okay, great. But as you know, this has been around for a while, so we're always here to answer questions as well. So Elijah, thank you again so much for sharing your time and your expertise with us. And if you have any comments or questions, put those in the comments below. Like and subscribe to my YouTube channel, and we will keep bringing you great, timely content like this as well. So thanks again, Elijah. You have everybody out there, I hope you have a great day, and let us know how we can help.
Awesome. Thank you, Lisa.